Most investors believe markets move because of news, because of earnings, because of geopolitics, because of innovation. Those factors matter, but they are not the primary driver of large, sustained market moves. Liquidity is. And most people misunderstand what liquidity actually means. Liquidity is not just volume. It is not just cash. It is not just trading activity. Liquidity is the ease with which capital can move through the financial system without causing price disruption. And when liquidity expands, prices rise. When liquidity contracts, prices fall, almost regardless of narrative. Let's start with a simple truth. Bull markets are rarely driven only by earnings growth. They are driven by multiple expansion, and multiple expansion is driven by liquidity. When central banks lower interest rates, capital becomes cheaper. When rates fall, discount rates fall. When discount rates fall, the present value of future cash flows rises. This mathematically justifies higher asset prices. But that's only part of the story. Lower rates also encourage borrowing. Borrowing increases spending, spending increases asset purchases, and asset purchases push prices higher. Liquidity expansion creates reflexivity. Rising prices increase confidence. Confidence increases risk-taking. Risk-taking increases leverage. Leverage increases buying power. Buying power increases prices again. This loop continues until liquidity tightens. Now consider the opposite. When inflation rises, central banks tighten. Rates increase. Liquidity contracts. The cost of capital rises. Discount rates increase. Future cash flows are worth less. Risk appetite decreases. Leverage becomes dangerous. Forced selling begins. And once liquidity dries up, prices fall faster than fundamentals alone would justify. Because liquidity is not linear. It disappears in waves. There is strong empirical support for liquidity's role in asset pricing. Studies show that global M2 growth correlates strongly with equity market performance over medium-term horizons. When global money supply expands, asset prices tend to follow. When it contracts, risk assets struggle. This is not coincidence. Financial markets are liquidity transmission systems. Capital flows into assets based on availability and cost. Consider 2008, it was not simply a housing problem, it was a liquidity freeze. Interbank lending halted, credit spreads exploded, confidence collapsed. It wasn't just that assets were mispriced, it was that buyers disappeared, liquidity vanished. And when liquidity vanishes, price discovery becomes violent. Now consider 2020. During the pandemic crash, markets collapsed rapidly, but they recovered even faster. Why? Massive liquidity injection, quantitative easing, emergency lending facilities, fiscal stimulus, trillions entered the system. Markets did not recover because uncertainty disappeared. They recovered because liquidity flooded the system. Liquidity expansion changes risk perception. Liquidity also explains why markets can rise during bad news and fall during good news, because news does not move markets in isolation. Liquidity conditions determine how news is processed. In high liquidity environments, negative news is absorbed. In low liquidity environments, minor news triggers outsized moves. The same information, different liquidity backdrop, different price reaction. Liquidity cycles also explain speculative bubbles. When capital is abundant, risk tolerance increases. Capital flows into progressively riskier assets. First large caps, then mid caps, then small caps, then unprofitable growth, then highly speculative themes, then meme assets. Liquidity expansion pushes the risk curve outward. Eventually, marginal buyers disappear. Liquidity tightens, speculation collapses first, then broader assets follow. The bubble was not purely irrationality, it was liquidity structure. Another dimension is market microstructure liquidity. In stable periods, bid-ask spreads are tight, order books are deep, execution is smooth. In stress periods, spreads widen, depth disappears, volatility increases, liquidity providers step back. This amplifies price movement. Volatility is often a symptom of liquidity withdrawal. Here's a key misunderstanding. Investors think volatility causes losses. Often, liquidity contraction causes volatility. Liquidity is the fuel. Volatility is the flame. When fuel is abundant, flames stay controlled. When fuel evaporates, sparks cause explosions. Liquidity cycles also affect correlations. In expansion phases, diversification appears effective. Assets move independently. In contraction phases, correlations converge. Everything sells simultaneously. This is not because fundamentals align. It is because liquidity becomes the dominant factor. Cash becomes king. Investors sell what they can, not what they want. Professional macro investors monitor liquidity indicators closely. Central bank balance sheets, yield curve shape, credit spreads, dollar strength, repo markets, bank lending standards. These indicators do not predict short-term moves, but they signal structural liquidity conditions, and structural conditions shape long-term opportunity. Liquidity also explains why passive investing has changed market dynamics. As more capital flows automatically into index funds, capital allocation becomes less sensitive to valuation. Liquidity concentrates in the largest names. This increases index level stability, but it may also increase fragility if flows reverse. Liquidity flows create structure. Structure creates patterns. Patterns influence behavior. There's also a psychological component. In liquidity expansion, investors feel skilled. In liquidity contraction, they feel unlucky. But skill often appears during expansion, and mistakes appear during contraction. Liquidity can mask fragility. It can hide structural weakness. It can reward poor risk management temporarily, until the cycle turns. So what does this mean practically? First, understand that asset performance is partly a liquidity function. Second, do not extrapolate bull market returns into tightening environments. Third, reduce leverage during prolonged expansion. Fourth, expect correlation shifts during contraction. Fifth, build resilience for liquidity shocks. The most dangerous assumption is believing liquidity conditions are permanent. They are cyclical. They are policy-driven. They are reactive. And they are influenced by macroeconomic forces beyond individual control. If you remember three things from this video. First, liquidity expansion inflates assets beyond fundamentals. Second, liquidity contraction reveals fragility. Third, survival depends on adapting exposure to liquidity conditions. Markets are not just valuation machines, they are liquidity machines. And understanding liquidity cycles is understanding the hidden engine behind booms and crashes.